Good morning and welcome to Investment Insights with Nedgroup Investments. I'll be your host, Mahini Naidu, and it is my pleasure today to welcome Ian Anderson of Merchant West Investments and lead portfolio manager of Nedgroup Investments Property Fund. Ian will be talking to us today about recent fund performance, some of the drivers of those performance, as well as the outlook from the sector that investors can expect. Ian, without further ado, welcome and over to you.
Thanks very much, Mahini. I don't think it would take me to tell people just how difficult it's been to invest in listed property in South Africa over the last 5 years. The sector has faced numerous headwinds. Obviously, the COVID-19 pandemic was a focal point of those headwinds, but the sector has also been faced with very low economic growth here in South Africa. We've seen an escalation in the incidence of load shedding. We then also saw very rapidly rising interest rates as central banks throughout the world tried to defend inflation. And then from a property perspective, we've also seen technological disruption impacting certain sectors like the office market and large shopping centers. Office market obviously impacted by more and more people working remotely or working from home, and then shopping centers being impacted as more and more people started to shop online. Obviously, there were some sectors that benefited from these technological disruptions. The fact that people are working remotely means that you need more data centers. There's more capacity required in order to store that data. So data center REITs have done particularly well. And then people need to store product in order to sell it online. And so we've seen a strong growth in the warehousing sector. But by and large, the headwinds have been negative more than positive. And that's reflected in the 5-year return. So if we look at the last quarter, it was a difficult quarter for listed property generally, but for the Nedgroup Investments Property Fund in particular, simply because we don't have the same level of rand hedge exposure that both the market and the peer group have. But I'll talk to that in a bit more detail. But I just want to focus on the 5-year number. That's where most of the pain has been experienced, been significant capital drawdowns, but importantly, the sector and the fund have continued to deliver a reasonably high level of income, and as a result, the returns, yes, they are poor, but they are not catastrophic. And I think when we get to look at the outlook for the rest of 2023 and beyond, we will probably see an opportunity. Maybe not immediately, but certainly there is an opportunity building for investors. The last 3 years, obviously the number is a lot better. We are looking at the period post the COVID pandemic. In fact, the listed property sector only really started to recover in November of 2021. So those 3-year numbers are likely to continue to improve, all things being equal over the next quarter. Again, the 1-year number impacted by the fact that the fund has little or no rand hedge exposure, or certainly has a lot less rand hedge exposure than the peer group, and the weak rand has clearly been a major driver. We also did see a strong recovery in some of the large cap stocks in the fourth quarter of last year, which is also impacting on the performance over 1 year of both the peer group and of the benchmark. Looking at the second quarter in more detail, we acknowledge that the fund has underperformed both the market and the peer group. As I've already mentioned, the rand weakened substantially during the quarter by more than 5%, and that had a positive impact on the returns of companies like Lighthouse, Mass, Nepi, and Sirius that have all of their portfolios outside of South Africa. The fund has exposure to Nepi, but it has no exposure to Lighthouse, Mass, or Sirius, and as a result of that, the fund underperformed. Negative contributions also from Dipula and Emira in the fund. Both companies reported results that were in line with expectations, so it's difficult to understand why there was such significant underperformance by both of those companies. I think in the case of Emira, there might have been some confusion in the marketplace. The company has changed its year end from June to March, and so the most recent numbers actually reflected a 3-month performance as opposed to 6 months, and that might have been a little bit confusing for the market, and as a result there was some negativity there. And then it's clear that at the moment there is very little institutional appetite for listed property sector, and that is reflected in the deep discounts to net asset value that we continue to experience, as well as very high and attractive forward income yields. Looking at the second quarter in a bit more detail, specifically just how high some of the returns were from those rand hedge stocks. Sirius was the best performer, returning almost 25%, and you can see the returns, the negative returns from both Dipula and Emira. Equitas was the worst performer. The results that they reported for FY 2023 were in line with expectations, but the company has warned that FY 2024 will be significantly lower than what the market was expecting and lower than what was produced in 2023. They've also announced the fact that they're looking to exit their development joint venture in the UK. Over the past 12 months, as I've already mentioned, we did see that strong recovery in many of the large cap stocks in the fourth quarter, and that's had a major impact on the relative performance of the fund versus both the market and the peer group. Obviously, I've already chatted about the second quarter performance being driven primarily by the weaker rand, and therefore in the fund didn't experience the same opportunity, or we certainly didn't have the same tailwind, given that the fund remains very much SA-centric. It's difficult to pinpoint why there was this huge outperformance by large cap stocks in the fourth quarter. It almost seemed like there was a bit of window dressing. Now, despite the fact that the fund only returned 1.3% over the past 12 months, there was a strong and continued strong income return of 9.7%. And this despite the fact that we received no dividends from Accelerate, who are continuing to look to shore up their balance sheet, and then Nedgroup Place, that is now the subject of corporate action. And we'll chat about that in a little bit more detail later on. In terms of the current fund positioning, we remain heavily overweight South Africa. The reason for that is one, it provides us with a substantially higher yield than what we get from both the market and the peer group. And then within that South African market, we are also have a high allocation to the Western Cape. It's our preferred region over and above both KZN and Gauteng. And Gauteng, in fact, is our least preferred region. One of the other reasons why we remain overweight SA and then underweight Eastern Europe is because we see substantial refinancing risk in many companies that went offshore. The fact that you now have high interest rates across most of Europe or rising interest rates across most of Europe is going to present a problem for many of the South African businesses that expanded rapidly offshore. And so we continue to favor South Africa over Eastern Europe. In terms of our thematic approach to portfolio construction, we continue to favor convenience and neighborhood retail over large shopping malls. We are still seeing significant growth in both turnover and footfall from convenience and neighborhood retail. We're also seeing very strong demand from retailers to enter these locations or to expand into these locations. So that's obviously driving market rentals. And then more recently, we increased our exposure to residential property. We get that through Octodec and Nedgroup Place. In fact, Nedgroup Place return over the last 12 to 18 months is close to 90%. Obviously, part of that is as a result of the corporate action taking place right now. Our Nedgroup Place position will be sold to SA Corporate at the end of July. But it does show that even within the sector, the market is realizing the attraction of residential property, particularly in a rising interest rate environment where home ownership becomes less and less affordable because mortgage rates are rising. We also have significantly higher exposure to self-storage than the rest of the market. We get that through storage, which has a portfolio both in South Africa and the UK. In fact, the South African portfolio is outperforming the UK portfolio, but both are doing incredibly well. When things get tough, when there's a lot of uncertainty around, people do tend to downscale. People tend to put more of their stuff in storage units, and we're seeing strong demand for self-storage across the globe, and we expect strong distribution growth from our exposure to storage over the coming years. Finally, in terms of our outlook for the rest of 2023 and 2024, distributions from the fund are forecast to decline by between 5 and 8% in 2023. That's mainly as a result of some of the corporate action that took place last year. Both Dipula and Fairvest were subjected to significant corporate action. Fairvest acquired Arrowhead. Dipula restructured its capital. It got rid of the A and B unit structure, and that did come with significant dilution for B shareholders. And those are the fund's two largest shareholdings. And then also, as a result of the more recent corporate action in Inlu Place, we didn't receive a dividend from the company, or we will receive a very small dividend from the company. They're retaining a lot of cash in order to continue to grow that portfolio. It is worth noting that at the moment, our forecasts for Inlu Place are for no income. However, the proceeds that we will receive at the end of July will be invested, and obviously there will be an income earned on those. So yeah, the 5 and 8% might actually be a little bit lower or less than that. The decline of 5 and 8% might actually be less than that. So notwithstanding this large decline, or this decline that we're seeing in distributions, the income yield on the fund remains well in excess of 11%. It'll probably be even higher than that because of the reinvestment of the proceeds from Inlu Place. We acknowledge that the sector continues to face significant headwinds in the short term. We've seen an increase in load shedding in 2023. We also have rising interest rates, albeit that those interest rates may now have peaked. But a lot of these headwinds are already reflected in the prices that these businesses are trading at. Most of them are trading at deep discounts to net asset value, significantly higher than the discounts that they trade at normally. I think on average, the sector is at around about a 35% discount to net asset value. And then yields, as I've already mentioned, are higher. The yield on the fund in excess of 11% net of fees. What we also see are pockets of opportunity that exist in the sector, both at a company level and at a property type level. However, we do acknowledge that just owning the index might not be appropriate, given the fact that the South African listed property sector continues to be dominated by offices and large shopping centres. So we would continue to favour our approach, which has been it's been a thematic approach to portfolio construction, looking for businesses that may be the subject of corporate action, or looking for businesses that own property types where fundamentals remain strong or where fundamentals continue to improve. With that, I'll hand back to you, Mohini. Thanks very much.
Thanks, Ian, for that update and your insights on the outlook for the sector. So just picking up on some of those comments that you made around the thematic approach to the portfolio, avoiding some of those office sectors, for example, focusing on the Western Cape, on residential, SA focused. Does the South African listed property sector have sufficient depth and breadth so that when there are these corporate actions like with Inlu Place, for example, that you're able to reinvest those proceeds into the themes that you favor? So if, for example, you think the residential sector still has sufficient tailwinds behind it, where would you be investing those proceeds from Inlu Place to retain that as a theme within the portfolio?
Unfortunately, especially when it comes to residential, there isn't that same depth and breadth that you have in the other property types. So as I mentioned during the presentation, the only two companies through which we get that residential exposure is Octodec and Nedgroup Place. So with the corporate action, we will reduce our exposure to residential. We don't mind. We're getting an appropriate price. So at this sort of price, we would have been offloading or reducing our residential exposure anyway in favor of convenience and neighborhood retail. We're probably going to look to add a little bit more into warehousing and probably also a little bit more exposure to the Western Cape. We will, however, the fact that Nedgroup Place is not leaving the listed property sector and is still going to be absorbed into another REIT, SA Corporate, we will probably look to increase our exposure to, all things being equal, to SA Corporate in order to retain some of that residential exposure. We still think that there is upside for residential given the high interest rate environment. We just don't want as much as we've had because we've already had the rally. I think just one point that I do want to make about the sale of Indu Place at this price, the yield that we are exiting Indu Place on is much, much lower than the yield we get on the rest of the portfolio. So it doesn't matter where we invest that money, it's going to be yield enhancing, whether it goes into more residential, whether it goes into convenience and neighborhood retail, or whether it goes into warehousing.
Thank you very much, Ian. You also spoke about the fund being an SA-focused fund as opposed to the sector which has more than half of its exposure to offshore markets. Now, just on the issue of interest rates being at multi-decade highs, both South Africa and globally, what is the refinancing risk in the sector from these higher interest rates than we've seen in many years? And in your opinion, does it impact local markets to the same extent as global markets?
So let me answer that question first. Absolutely not. So I think it's really in global markets, the refinancing risk is probably the biggest headache that REIT investors face, and probably the biggest headache they've faced since the COVID-19 pandemic. In South Africa, we've seen 3 and 5 year rates move from around 7.5% or 8% to 9%. That's not significant. Most South African REITs will be able to absorb that. There'll be a small decline in cash flows, but that'll be more than made up by the contractual escalations that we have in all of our lease agreements. The situation globally, and particularly in Europe, is much more different. You've gone from yields or rates of 1.5% to 2% on 5 year money to now yields and rates of between 5 and 7%. That is a substantial difference. And in fact, in most instances, the interest rate on that debt is now higher than the yields on property. And so you go from a position of very strong cash flows to having those cash flows almost completely wiped out. Obviously, it will depend on the level of gearing, but we've already seen companies like Growthpoint, for example, in an update to the market just recently, warning that their 2024 distributions or dividends are going to go backwards because of the refinancing risk that the company faces on its non-South African portfolio. They've also got a significant investment into Eastern Europe. It's mainly offices. The level of gearing there is very, very high. And as these interest rates have been rising, the cash flows from that investment have basically been wiped out. So, it'll be company specific, depending on how much gearing you have and just how substantial that refinancing risk is. But clearly, it's a lot more significant in Europe than it is here in South Africa. And for that reason, we'll continue to have a much higher allocation to South African assets.
Very great. On the theme of storage and Equitas, that's been one of the favorites in the portfolio for some time, but you had actually started to trim that position into the fourth quarter of last year, going into the first quarter of this year. Now, we noticed that you've again increased your exposure following the very significant decline in performance recently. Can you talk to us about the rationale for this? Why the decrease in Q4 and Q1 only to increase it again now?
So when you invest in REITs, you don't just invest in property, you also invest in the structure that surrounds that property. And so you don't just look at what the property portfolio looks like, you've got to look at the capital structure that surrounds that property portfolio. You've got to look at the management involved in managing that property portfolio. There are a whole host of other issues that you need to factor. It's not just about, we want to own warehousing property, therefore we want a big stake to Equitas. Equitas had adopted some very aggressive accounting practices, which we felt were unsustainable. And so we went from being almost 2 times the sector weight to being at sector weight by the time we entered the first quarter, because we felt that at some point, the market's pressure on Equitas to start to remove some of that aggressive accounting would result in lower distributions or lower profits going forward. And that's exactly what has happened now after the release of their last results. They are no longer going to include the income they earn on cross-currency interest rate swaps in their distributable income going forward. They're also, as I mentioned, looking to exit the JV. I think in time they will also start to capitalize less interest and less costs associated with their development pipeline. In fact, offloading their development pipeline in the UK will automatically mean that there will be a reduction in distributable earnings from that source of income. So we had anticipated that the company would at some point make an announcement that they would be looking at a substantial reduction in distributions going forward. That announcement came through with the release of their 2023 results. The share price has fallen substantially. The business now is less risky from an accounting perspective. It still has a very good quality portfolio. So on this much lower price, we were, and the fact that the accounting treatment or the removal of some of those accounting red flags has prompted us to increase our exposure. We haven't increased it substantially. We're certainly not back to 2 times the index weight, but we are at around about 1.25, 1.3 times index weight, with a view to continue adding to it as more and more of these accounting red flags are removed from the Equitas numbers. We still like the property type. It was just the structure was becoming uncomfortable for us. We're a little bit more comfortable with the structure now.
Thanks, Ian. I think we have time for just one more question. We've seen that investor appetite for the sector has waned, and for very understandable reasons, with load shedding and office vacancies not coming back strongly post-COVID. But does this asset class still have a role to play in investors' portfolios? Or, to put another way, why should investors remain invested in listed property?
If you look at the way that the listed property sector has performed over the last 20 or 30 years, the one thing that we can clearly see is that it's highly cyclical, and it gets the most cyclical during periods of significant changes in interest rates. So the last time that interest rates were raised rapidly in South Africa, the listed property suffered 50, 60% price declines. Then when interest rates were cut, and again, they were cut quite aggressively because obviously that high interest rate environment was just not sustainable, we suddenly saw a significant increase in the capital values of property. Not only do their dividends start to rise because the cost of their debt is declining, but also the value of the property increases because the discount rates that you apply in the valuation process are a lot lower. So I think the fact that we have probably seen a peak in interest rates, certainly here in South Africa, the Reserve Bank has gone on hold and has probably increased for the very last time. The Fed is likely to increase maybe once more. The ECB is probably likely to raise once more. Central banks are all desperately looking to start cutting. Some may start cutting as soon as the fourth quarter this year, others only in the first quarter of next year. But that should provide a substantial catalyst for the listed property sector, given what has happened in the past and the fact that we've gone from a rapidly increasing interest rate environment to potentially a rapidly declining interest rate environment. One of the other positives that we think is developing, certainly from a South African perspective, is that we feel certainly that the worst of load shedding is behind us. We're getting through our winter, which is one thing, but I think too, we're starting to see a lot more capacity, private energy capacity coming on stream. The private sector it is fulfilling the role that Eskom previously fulfilled. So the pressure on the grid, the pressure on the system is being eased, and that should be positive for our economy. The big question, however, Mohini, is when all of these things start to be experienced or felt in the listed property sector, and that's the big issue. However, if you start investing today, you are going to be compensated for waiting for the recovery to happen by the very high yields that you get. So, you know, it's in very few places that you can get an 11 or 12 or 13 or 14% yield on an investment, trading at a substantial discount to net asset value while you wait for a recovery that is likely to come based on what has happened in the past. So if we look at what happened in 98, 99, if you go back to sort of 2007, 2008, you go back to, you know, the other periods where we've seen these rapid increases in interest rates, the listed property sector has actually been the best performing asset class in the 2 or 3 years after interest rates have peaked. We don't know if history will repeat itself, but certainly you're starting from a position where the sector is unloved, where you're at deep discounts to net asset value, and where yields are at historically high levels.
Thanks very much for those comments, Ian. I think that's all we have time for today, but thank you very, very much for your time, and thank you to our listeners for dialing in. If there are further questions that you have for us at Nedgroup Investments or for Ian, we'd be very happy to take them. Please contact your business development relationship manager. And in the meantime, buckle up. It's going to be a bumpy ride.